Welcome to Invest in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that you can become a great investor. How? By building the right plan and then sticking to it. According to Warren Buffett, that's what it takes to set yourself apart. And everything we do here is meant to help you get there. So thanks for joining us. You can always find more at investinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And if you want to join me on the path to becoming an intelligent investor, simply text the word JOIN FAMILY. That's one word, JOIN FAMILY, to the number 44222, or visit investinthefamily.com and sign up. We'll make sure to take care of you so you don't miss a thing as we work together to become better investors. Also, a special note I want to make you aware of is that in late January, we have a very special event we're going to be offering here from Investor in the Family in partnership officially with Seeking Alpha, which I'm very excited about. It's called the DIY Investing Summit. You'll learn more about it in coming weeks through the email list and this podcast, so stay tuned. But it's going to be an incredible opportunity. I'm trying to be careful not to oversell myself, but I really feel like it's the potential to be have a significant impact on everyone who attends this online event in terms of helping to the potential to significantly reduce the number and magnitude of mistakes that we make, help have a significant impact in terms of reducing the amount of time we spend in our investing activities, and help us to be more focused and diligent with our time, and potentially see much more fruit and more significant positive returns as a result of this information as well. No guarantees, of course, because that depends on how you apply things, what happens in the markets and everything else. But the bottom line is the wisdom and the advice and the input is here to potentially have a significant impact for anyone who is willing to take it seriously and follow through with it with wisdom. So that being said, you'll be learning more about that event in coming weeks through the podcast and through the email list, so be sure and stay tuned for that. In the meantime, let's get started with today's podcast. And we're going to be going through an article on Barron's magazine, Up and Down Wall Street, this week written by Cope and Tan, since Randall Forsyth is out on vacation, given the holidays. That's also why the podcast is coming out on Thursday instead of earlier in the week, because holidays, and I took some holiday. So there's that. So this week's article is titled Sense and Sentiment. Not the title that I'm going to use, but that's what it is. And so let's jump through and find out what's going on around the world today and what it means for you as an investor. So again, big news continues to be the ongoing bull run that has been taking place since Donald Trump was elected as president. Pretty much everyone expected a significant market pullback, warnings of market crashes and corrections if Trump were elected. But it seems that even people who warned of big corrections if Trump were elected, even many of those people are now calling for bigger gains to come. Okay, so flags should be going off, or alarms should be going off in your mind right now, because that's a sign of extreme bullishness, which usually is something we want to be cautious of. More evidence of that. The volatility index, known as the VIX, fell to its lowest level in 2.5 years last week. Okay, so that's basically saying that investors just are not expecting anything bad to happen, and that's usually when something bad happens. Again, not trying to be scary or that kind of stuff, and no one knows the level of that, but bottom line is when people get overly complacent and bullish, that's usually when we want to be on our toes and on guard for a shift of gears or maybe even something negative to happen. More evidence to the point, the crude oil volatility index, or the OVX, fell to 2-year lows. Treasury yields, that's on the 10-year Treasury, have jumped above 2.5%, up from lows at 1.36% just after the Brexit vote back in the summer. Was that July? I forget. So you've got volatility is low, crude oil volatility is low, Treasury yields are at their highest level in a long time, and the S&P 500 recently traded at 22.3 times earnings, or 23.2 times what its companies earned in the previous 4 quarters. So that's called trailing earnings, earnings that have already taken place, trailing behind us. 22.3 times. That's really high compared to historical numbers. How high? Well, it's higher than 92% of the readings since 1929. So I think that's another way of saying, basically, it's in the top 92 percentile of price earnings ratios. So meaning it's higher than 92% of the other times, any of the time since 1929. Okay. And 1929 obviously is significant because that's when that little thing called the Great Depression got started from the massive, was it Black Monday? Is that what it was? when the stock market crashed back in 1929 and launched the beginning of the Great Depression. You may have heard of it. So the previous 9 times when trailing price earnings valuations topped 22 times, and again, right now they're at 22.3, the index saw pullbacks on average of 2.6% 3 months later and 6.2% 6 months later. So you're thinking, okay, it doesn't sound like a big deal, but basically on average, when this has only happened 9 other times that the S&P 500 PE ratios have been above 22, and in those 9 times, 3 months later, the market was on average down by 2.6%, and 6 months later, on average, was down 6.2%. So basically, that's saying, on average, the market was down 2.5%, a little over 2.5%, a little over 6%, 3 and 6 months later, respectively. Idea behind that is that, historically speaking, when we get to the levels that we're at, 3 months down the road, 6 months down the road, the party is not still going on. Things are not, we're usually worse off than we are now. And, again, I've been doing a lot of interviews of late for the summit coming up in late January. And that seems to be the sentiment of a number of investors that I respect, is that, again, once you get to the high valuations that we're at right now, that doesn't mean a crash is coming or even a pullback is coming. It could continue by all means. But the bottom line is the odds are highly, and probabilities are highly in favor of negative things happening over positive things happening. So again, this doesn't mean doom and gloom. This doesn't mean sell everything and sit on cash, or sell your house and buy a big bar of gold or any of that kind of stuff. But it does mean be smart, be cautious. Now is probably not the best time to be buying new stuff unless, again, valuation for that particular stock is good. And this is where, when people talk about it being a stock picker's market, it's that as a whole, the market's overvalued, but that does not mean there aren't any opportunities out there. So, if you find a good valuation on a company, then by all means take advantage if you think it's a good idea. But generally speaking, now is probably not the best time to be, it's not the best time to be overly bullish, because the market is extremely bullish and we want to be contrarian and counter that internally by being a little bearish. Again, nothing extreme in my opinion or over the top, but maybe a little more allocation to cash. Maybe we kind of just sit on pause for a little bit in terms of not buying new stuff, or maybe you put some hedges in place, for example. One thing I have not done over the last few weeks, but I've been intending to reach out to some investors that I respect and talk about the whether or not there's a good opportunity with the VIX, a VIX trade of some kind, maybe buy some options or something on VIX to potentially benefit if volatility does ensue in coming months. But that gets to be really tricky. I'm in no way at all recommending you do that. But if you're concerned, perhaps there's an opportunity for you to put some hedges in place. Bottom line is, don't get caught up in all the crazy bullishness right now. And also don't go insane, scary, crazy, bearish either. That's my opinion. Do what you think is best. So let's see. So that's where we're at, 22.3 times trailing earnings, price rate, PE ratio. So that's something to be aware of. Also, sentiment has improved overall regarding the markets, but data says household spending has not, which again is one of those ideas that, okay, the markets are doing well, but is the economy backing it up? It's that question that's been looming for so long in the current recovery period or post Great Recession period. The U.S. economy may be, quote unquote, humming along, says Nicholas Colas from Convergex. No idea who Convergex is, but when you get quoted in the leading article of Barron's magazine, I assume you're reputable. That's my mindset anyway. So the U.S. economy appears to be, quote unquote, humming along, according to Nicholas Colas, but it needs a new catalyst to show investors that we aren't at the peak of the current cycle. So, okay, again, the idea, like I've been describing, we could be at the peak of the current bull market or current cycle unless some new catalyst comes along to say, okay, we're going to keep this going. And that very well could happen. Obviously the market is very optimistic that Donald Trump will do something like that, but we have no way of knowing. So I don't want to put too much hope in that at the moment. For now, sentiment is enough, but in 2017, the new administration, that's the Trump administration, will need to deliver. That's like I just said. The IPO market was down big in 2016 to, I think, its lowest level since the financial crisis, the Great Recession. So lowest level since 2009. But according to Kathleen Smith of Renaissance Capital, The IPO market could be poised to rebound in 2017, and she estimates the pipeline of companies that could be going public to be around 250 strong, and it was at 275 in 2014. So still down from 2014, but I don't know if they put the numbers for 2015 in there, but obviously they're very low. And apparently the spigot could open up measurably in mid-February of 2017. And one of the more notable companies that's filed to go public is Snapchat. So depending on how old you are, you may or may not know what Snapchat is, or you may or not have any experience with it. Actually, funny thing about Snapchat, I was with someone, I think this person was in high school. I think she was a sophomore, junior in high school. We were hanging out with some at an event at my local church. And I just asked her, I was like, hey, what are the big social media things right now? Since all that anyone seems to care about is what teenagers are doing, at least when it comes to social media. And if I remember correctly, she made the comment that basically she said Twitter and Instagram. So, which I thought was really interesting. Instagram wasn't surprising, but she did not mention Snapchat, because apparently some of the new developments within Instagram with their stories thing, I don't use it very much, but that basically is kind of, in her opinion, has made Snapchat not as relevant. And so apparently her and her friends and people in her high school community are much more active. They've switched back from Snapchat to Instagram, and they're using Twitter a lot. So that just goes to show like how ridiculous Wall Street and investors can be when they're trying to predict which one of these is going to be the biggest, and they switch back and forth every 3 to 6 months as far as what next thing is going to change the world until the next thing does. So keep that in mind. And also note, obviously, that Instagram is owned by Facebook, and so that's cool for them. And apparently the news lately seems to be really bearish on Twitter, which it has been for a long time, but even more so than normal. So do with that what you want. But hey, there's the deal. Hey, Merry Christmas. I hope you had a great Christmas. I hope you have a Happy New Year this weekend. Be safe, please. Use good judgment in whatever you do. And if you're overseas, I'd love to hear what you're doing to celebrate New Year's. Shoot me an email, Brian, Brian, at investinginthefamily.com. Would love to hear from you. And also, stay tuned for more information on the DIY Investing Summit. I could not be more excited about this. And I've been putting a lot of work into it. That's one of the reasons you have not heard many other interview podcasts for a while, because I'm doing a lot of interviews for the summit, and they are a gold mine. Every one of these could stand alone and be worth $100 or hundreds of dollars in my opinion, but it's not what you're going to charge. I'm not going to charge that much for it, so don't worry about it. Actually, it's going to have free access, and so because you guys are awesome, and I want to reward you like that. Anyway, I'm rambling right now, so why would you listen to someone rambling? You wouldn't. So anyway, this is me, Invest in the Family Radio, and don't forget to subscribe at iTunes, Stitcher, or the Google Play Store. You can get show notes and links and all that kind of stuff at investinginthefamily.com. And if you want to follow the email list, text the word Family Notes, one word Family Notes, to the number 44222, or visit investinginthefamily.com. And this is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.